Everyone says crashes come from bad news, a war, a virus, a bank failure. But the most dangerous market crashes don't start with panic. They start with calm. They start when the headlines are optimistic, when unemployment is low, when earnings look fine, when experts say, this time is different. And then, without warning, the floor disappears. That's not a bug in the system. That is the system. Right now, this question matters more than people realize. Because markets don't collapse when things look terrible. They collapse when things look safe. Let's talk about why. Imagine you're standing on a frozen lake. The sun is out. The ice looks solid. People are skating. Someone even brought a chair. No cracks, no noise. No warning. And that's exactly when the ice is most dangerous. Financial markets work the same way. When everything looks fine, risk doesn't disappear. It hides, it stacks, it compounds. And then it moves all at once. Here's the uncomfortable truth most people never hear. Markets don't crash because something breaks. They crash because too many things were quietly holding each other up. Let's rewind. In healthy markets, prices move for simple reasons. Companies earn money, they grow, they fail. Investors react. But modern markets don't run on simplicity anymore. They run on expectations layered on top of expectations. Borrowed money on top of borrowed money. Promises backed by other promises. Confidence built on confidence. And confidence is fragile. The first ingredient of a nothing looks wrong crash is leverage. Leverage is just borrowed money, using $10 to control 100, using confidence as collateral. Leverage feels invisible when prices rise. It feels smart, efficient, optimized. When asset prices are climbing, leverage looks like genius. But leverage doesn't care why prices move. It only cares that they move. And when prices move the wrong way, even slightly, it turns from fuel into fire. Here's where it gets interesting. Most crashes don't begin with people selling because they're scared. They begin with people selling because they have to. Margin calls, liquidity requirements, risk limits. Forced selling doesn't wait for fear. It ignores optimism. It just executes. But forced selling alone isn't enough to crash a market. You also need concentration. When everyone owns the same assets for the same reasons, the market becomes brittle. On the surface, it looks diversified. Thousands of stocks, hundreds of funds, complex strategies. Underneath, it's often one trade. Same assumptions, same models, same signals. When those assumptions hold, nothing happens. When they don't, everything happens at once. This is why crashes feel sudden. They're not sudden, they're synchronized. Take a step back and notice the irony. The more advanced markets become, the more fragile they get. Risk models smooth volatility. Central banks stabilize cycles. Algorithms remove emotion. All of that reduces small shocks, but it also removes pressure release valves. So instead of small corrections, you get silence, and then avalanches. Now let's talk about the part no one likes to admit. Markets crash when they're overconfident about stability. Stability becomes an assumption, then a strategy, then a dependency. Low volatility convinces investors to take more risk, more leverage, longer horizons. Because if nothing bad has happened in a while, the system feels safer. That's backwards. The absence of volatility doesn't mean less risk. It often means risk is being stored. Think of it like a spring being compressed. Every calm month pushes it tighter. Every soft landing narrative adds pressure. Nothing snaps until it does. And when it does, the move isn't gradual, it's violent. Another hidden mechanism is liquidity illusion. In good times, markets feel liquid. You can buy and sell instantly, tight spreads, plenty of buyers. But liquidity isn't a permanent feature, it's a mood. When everyone wants to exit at the same time, liquidity vanishes. Not slowly, instantly. Prices don't fall because people change their minds. They fall because there's no one left on the other side of the trade. This is why crashes feel irrational. The math hasn't changed, the companies haven't vanished, but the buyers have. And once prices start falling, something else kicks in. Feedback loops. Risk models force selling as volatility rises. Funds reduce exposure to stay within limits. ETFs transmit selling across entire sectors. Each sale increases volatility, which triggers more selling. No conspiracy, no villain. Just rules doing exactly what they were designed to do. Here's the quiet, uncomfortable punchline. Markets crash when they are doing exactly what they were optimized for. Efficiency, speed, stability. All of it works until it doesn't. Now, let's contrast hype with reality. The hype says markets are forward-looking, that prices reflect all available information, that risks are priced in. Reality is messier. Markets are forward-looking collectively, but decisions are made individually. And individuals respond to incentives, not abstract truths. If your bonus depends on this quarter, you don't price long-term risk. If your fund tracks an index, you can't step aside. If your model worked for 10 years, you trust it until it fails. Crashes are not failures of intelligence. They are failures of alignment. Everyone doing the right thing at the same time creates the wrong outcome. Zoom out even further. The biggest crashes rarely come from unknown risks. They come from known risks that were ignored because nothing happened last time. Housing risk before 2008. Interest rate risk before bond sell-offs. Liquidity risk before every crisis ever. The danger isn't ignorance. It's familiarity. When a system survives stress repeatedly, people stop respecting the stress. And that's when fragility peaks. So why does this keep happening? Because markets are human systems pretending to be mathematical ones. They run on confidence. They run on trust. They believe that tomorrow will resemble yesterday. And when that belief breaks, prices don't adjust. They reprice. Fast. Brutally. Indiscriminately. This brings us to the final, uncomfortable question. If crashes happen when things look fine, if risk hides in stability, if calm is when leverage, concentration, and confidence quietly peak, then what does safety actually mean in markets? Is it low volatility? Strong earnings? Reassuring headlines? Or is it the opposite? Periods when fear is visible, when prices have already fallen, when optimism has been drained out of the system. Markets don't warn you with sirens. They whisper. And the whisper usually sounds like this. Relax. Nothing is wrong. The real question isn't whether the next crash will come from bad news. It's whether we'll recognize the danger when everything still looks perfectly fine.